All right, Hail nerds. We're going to discuss a very popular terminology that is used in the market called hard landing, soft landing, softish landing, and understand what that means and also what does it mean in terms of what you may want to do. And so let's get started. The way we're going to approach it is always to remind you that this is education. It is not investment advice. You make the decisions. My goal is to share what I'm learning. I am not sponsored by anybody. I do not have t-shirts to sell you. So let's have that as the basis and start looking at hard landing. The way we're going to organize it, first we're going to look at what is the Fed and what is the goal of the Fed. And then look at how the Fed is doing in terms of achieving their goals as of today. And look at two or three scenarios of where it is likely to go in terms of what we call the landing. And based on all of those lessons, what are the most likely lessons you can take with respect to how you manage your stock and your bond portfolio? All right. One thing, if you are new to this show, please look for the playlist. The playlist is available right here, and that organizes this show from somebody who is a novice to fixed income all the way to this show, and it's organized in a sequential manner. Having said that, let's talk about what the goal of the Fed is. The goal of the Fed, everybody knows they print money and ship them in bags. If you see a bag like that, call me. Anyway, the goal of the Fed, well, it really is a combination of goals. The first is maximum employment. People who want a job should largely be able to find one. The second goal is stable prices. You may have a job that pays you $1, but your spending may erase 85 cents of the dollar, and then you may not even be able to save the other 15 cents of the dollar because things that cost you 85 cents this month may cost you 90 cents next month and 92 cents the following month. So eventually, your price increases may erase your earning potential. So the goal of the Fed is really twofold: keep the economy at full employment or near full employment, and control prices. And there is one more goal, and that goal is to moderate, not too high, not too low, moderate long-term interest rates. The reason is because the Fed controls money supply. If you pump too much money into the market, it gets overheated. If you suck out too much money away from the market, it becomes hungry and it triggers a recession. So the Fed has a job of moderating long-term interest rates, not the short term. The short term is a tool to get to the long term, but the Fed has that responsibility. So it is a trifecta of these goals that the Fed is responsible for. This is a quote directly from a paper called About the Fed in the Federal Reserve website. I would suggest you go find that paper and read it. It is extraordinarily well written. All right, how is the Fed doing in its three goals? Now, I would imagine very few would ever even dare to say that the Fed isn't doing a good job in keeping full employment. It is an incredible achievement that unemployment is very, very low. You know, and I know, we could walk to practically any store on Main Street and they will say help needed. And that is an indication that the economy is short of workers, skilled and unskilled. There are a lot of job postings and there may be a skills mismatch, but at the end of the day, if you want a job, you can get one. And so unemployment wise, the Fed is doing an incredible job. How about inflation? Well, you can sit here and say, wait a second, inflation has skyrocketed post-COVID. Some of it was bound to happen because there was a tremendous money supply that was given to prevent the economy from crashing. Now, once that money supply is being sucked out, there is talk about disinflation. It is happening, it is not yet there. I would say it's a work in progress in terms of core inflation. The Fed is trying to use its tools to try to bring it down, and that is the battle at the end of the day. The third, which is the weapon that the Fed uses, these are short-term interest rates. But as you can see, we came from near zero interest rates post-COVID, and the Fed has taken it up a steep incline. It is still nowhere near some of the crazy rates that were there in 2000. However, that is not having the intended effect. What do we mean by that? Inflation should be coming down as interest rates go up, but as you saw in the previous page, inflation is proving to be a little more sticky than the Fed may have originally anticipated. So where do we go from here? In theory, if interest rates increase, the big ticket items, what are called durable goods, that should decrease. People shouldn't be going out and buying the $2,000 flat screen TVs and the $20,000 cars, and some cars are $100,000. Those things should decrease. Bankruptcies should increase. Now, nobody wants businesses to go bankrupt, but at the end of the day, if a business is highly leveraged, meaning they have a lot of debt, and the debt is a floating debt, meaning it increases when interest rates increase, as the Fed jacks up the interest rate and keeps it higher, these companies should be unable to pay their debt, and bankruptcy should be pushed up, which means the employees would be let go, which means unemployment should actually be pushed higher. My apologies. That should push employment lower or unemployment higher. Another thing that ought to happen is spending should decrease. The customer or the citizen who now has a higher interest rate to contend with, greater economic uncertainty, more bankruptcies, fewer durable goods, is going to start tightening their wallet, and spending will decrease. Generally, there is a lag in the spending decrease, and that will slowly slow down the economy to a point where inflation will come down and interest rates can then soon drop after that. That is the theory. Let's see how this theory is working today. The first, we're going to look at durable goods purchases. Is the rate of durable goods purchase coming down? Here it is. This is the last 25 years, and as you can see, during the 2008 crisis, for example, or during the COVID crisis, there was a tremendous deceleration, and we are kind of sort of headed in that direction slowly, but it's not like it is a huge effect. So I would argue durable goods purchases are not really changing to a point where the Fed can say, okay, it works. We're not there. Then let's look at bankruptcies. Is the Fed policy forcing companies to go bankrupt? Well, bankruptcy rates have actually trended lower, maybe a tad bit higher. Part of the reason is if you gave 0% interest rates, I'm going to go borrow a bunch of money, and I may have opted for fixed interest rates in those cases, or I might be paying 1% or 2% for the next 5 years. So there isn't that much of a change in bankruptcy rates. And so employment is staying high. That is one of the reasons. Not too many companies that are going belly up. And there are earnings pressures, but bankruptcies are not changing. Then you look at, okay, is there a spending lag that is happening? Is the customer tightening their purse strings? And surprise, surprise, to the contrary, spending is actually going up. And you sit there and go, what in the world is happening? How could spending be going up? You look at what you are spending yourself. There are certain areas that you're not spending. There are other areas where you're like, well, I'm going to go buy this, whatever it is. And so the consumer is powering the economy towards more and more sales, which means the pressure and the intended effect of higher interest rates are not yet working. The last part that I'd point out is inventories. If there are only 5 cars in the car dealer parking lot, they are going to say, well, I'm going to price them higher. If there are a ton of cars there and they want to get rid of it, they're going to price it lower. As we can see, inventories are dropping, but they aren't in a situation where there is a glut or there is a huge amount. And that means the pricing pressure just isn't there. So the aggregate of all of this is that there isn't a clear path towards progress in terms of what the Fed would like to see. And so, in theory, the economy should have already slowed down because the Fed has jacked up interest rates, but we still are in the process of heading there. As you can see here, the GDP is contracting. We are moving in the right direction in terms of what the Fed would want. Meaning, if I gave a whole bunch of money, free money, when I say 0.25% interest, which is practically free, if there was a ton of money supply that was given, and that precisely was to take the GDP that had crashed by a huge amount during COVID and bolster it back, and the GDP did come roaring back, and we're trying to control it, take the money supply away. And this is what people mean by there is going to be a recession soon, there is going to be a recession soon. If there are successive quarters of contracting GDP, we call it a recession. And so we are headed there, but ideally we would head there with the other two things, unemployment and inflation, also moving in the right direction. And that is where there is a disconnect. So let's talk about hard landing, soft landing, softish landing. So here is GDP and inflation side by side. You would think that as the economy contracts, inflation decreases. That would be the logical conclusion, because if we are not growing as much, why are we able to still afford and buy high priced items? There should be a demand destruction as GDP declines. Instead, inflation is sticky. A hard landing is where the Fed says, to hell with it, I am going to jack up rates, I am going to crash the economy, and the GDP comes tumbling down because the Fed has created an economic event where you cannot afford, businesses cannot afford these things, and inflation comes plummeting down to that 2% that they are looking for, and that would create a hard landing. It happens very, very quickly. Now, Chairman Powell at some point was talking about a soft landing. A soft landing is where GDP is coming down, inflation is starting to come down, and GDP would kind of come down a little bit, but it would still go up by not a whole lot. So the country continues to grow, and magically inflation alone drops to 2%. That would be amazing if we can deliver that, where we keep GDP above zero, so there is real growth, and we decrease inflation. That is prosperity for the country. That would be amazing if we can deliver it. And then there is a talk of, well, there is really this softish landing. Now, what's a softish landing? There is some recession, kind of a mild recession, but we did take care of inflation. Inflation dropped and came down to the 2%. So these are the three concepts, but there is a fourth term being thrown, and the fourth term being thrown is no landing. What do you think no landing is? It is a scary reality. No landing is where the recession does happen. It could be a small recession, big recession, and inflation remains. That is what we call a stagflation. The economy isn't growing, maybe contracting, inflation still is high. And if that happens, we are in deep trouble. So where do we go from here? You have to look at what is happening in the world economy and the US economy to understand, is it a hard, is it a soft, is it a softish, is it a no landing? Well, there is Ukraine war, and if you read recent news, there is a threat of sanctions on China. Well, if the US throws sanctions on China and says we cannot buy this from you, we won't sell that to you, what do you think that is going to do to prices? They will increase. If China, as crazy as it sounds, decides to escalate the conflict with Taiwan, what do you think will happen? The US will be forced to respond in whatever manner it is. It will cause economic uncertainty. Some commodities that are hard to get are going to go up in prices. Arguably, there will be softness in other parts of the economy, so there's a lot of uncertainty there. If the government says we're going to keep increasing interest rates because we need to break this cycle, then they will certainly trigger the recession that they kind of want. They want a softish landing, meaning they do want the GDP to go below zero, but they want inflation to drop very quickly. So that track will take us towards a recession. And companies now are trying to say, well, instead of raising money in bonds, because I can't compete with treasuries at 5 point something percent, so I'm going to issue convertible debt. But boy, do we have a deal for you. Google recent convertible debt rates. Used to be that convertible debt will be a couple of points above the prime rate or the federal funds rate. And so the company will say, not only do you make 5%, when I say 5%, this goes back 3 years, 4 years ago when interest rates were 2%. So they will say, I'll give you more than the 2% you can make at treasuries, and our stock is going to go up. So you get to make both the appreciation on the stock and the higher interest rates. We are the hot thing in the world. These days, companies are trying to say our stock is so depressed, we are such a good deal that we're not even going to match the safe treasury interest rate. We're going to give you 2% today, which is less than half of the treasury interest rate. But hey, it converts into equity, or equity is going to be the greatest thing since sliced bread in 2 years or 3 years. So buy convertible debt. You do your math on whether or not that is the correct calculation. Sometimes it may be, sometimes it may not be. So the question then is, based on everything here that is going on, corporations can't raise debt. They can't match the Federal Reserve interest rates. Interest rates are up or going higher. There is macroeconomic conflict. Soft or softish landings look a little slim. And hey, there is one more thing that you may not quickly think about. 90 days later, there are debt ceilings that are coming up. There is a huge yield event that may happen June, July, something around there. The only thing that can save us is the two political parties suddenly working with each other for a better future for our country. Hey, by the way, I do crack good jokes, and there is a really good one. The two political parties working with each other. How about that? I can't even say it with a straight face. So 90 days to go. Here is what it looks like. Short of a world order changing event within the next 90 days, inflation will be sticky. GDP probably will drop. We will head to an official recession. Stocks will have downward pressure because you can't raise debt at these rates. The convertible debt at a lower percentage will have its own percentage of success. Interest rates are unlikely to be dropped right away. And there may be a threat of a default. Whether it happens or not, there will be a threat. Given all of that, guess what yield nerds should do? Eat more ice cream. Meaning load up on less than 3-month treasuries and get ready for a yield storm. Do not increase duration. That is what I would do. You do your own decision on that. If you have any questions on the worksheets, the source of the data here, feel free to email me. Thank you, and we'll chat in a few weeks.